Okay, markets are down, and we've been sort of reporting on the 500 plus point, make it 550 now, point cut that we have. And some of the other market indicators are at the bottom of the screen, Dow Futures and, a few others as well. Let's welcome in Varun Goel, who's with us of Mirae Asset Investment Managers. Varun, good to have you on the program. Prashant here. First quick comment on what your sort of perception, what are you hearing, this kind of selling? What's it on the back of, in your opinion? On the domestic inflow side, again, it's too early, but so far, if you have any sense whether the numbers remain as strong as ever, monthly inflows are to the tune of some $4 billion over the last many months. So this month, what's it looking like? Actually, over the last couple of days, what's it looking like, if you have a sense? But start with the drivers for what's leading the market lower.
Yeah, good afternoon, Prashant. Thank you so much for having me. I think as far as the monthly numbers are concerned, we have to wait for, 7th of the month. That's when the industry data comes out. I would not have any latest data that I would be able to comment on. But from broadly what we have been seeing, the domestic inflows seem to be on track. I don't think there is any major deviation, but let's, of course, wait for the data when it comes on the 7th of the month. Broadly, I think if you look at the valuations, we are trading at around 20 times FY26 earnings, which is around 8 to 10% more expensive than the historical average. So I think a 5-10% kind of a correction, if it happens for geopolitical reasons or otherwise, could help take away some froth from the market and make the medium to long-term outlook more attractive. So as such, we would not be too concerned about what has happened in the last few days, and hopefully the medium to long-term India growth story and the earnings outlook remains largely the same.
So is that the view that from the top, obviously no one can forecast, but it's possible we get to between 5 to 10% kind of a pullback? We perhaps get that?
So we don't know, of course, Prashant, we need to monitor the geopolitical developments very closely. And of course, just to add to that, if you look at the domestic data points, they have been little on the soft side. The high frequency data in terms of GDP growth, the PMI for manufacturing services, auto sales data. And of course, today being the first day of Navratri, this is the beginning of the festive season. We do hope that the domestic consumption really picks up during the festive season. Also, if you look at the capex data a little bit, roads, railways, defense, in the first 6 months of this fiscal, it has been a little subdued. Of course, there were elections and all, and one hopes that in the next 6 months, it can catch up to meet the full year budget target. So these are some of the data points that we should also track from a domestic perspective. I think as far as earnings are concerned, FY20 to 24, we had almost 18 to 20% compounding in Nifty. Going forward, at least for FY25-26, our expectation will be a little more muted. Maybe 10 to 13, 14% kind of earnings CAGR from this point onwards looks more likely, and that is how we should be looking at the market.
Varun, hi, afternoon. You said that how some of the high-frequency domestic economic indicators are a bit subdued and tepid. So how are you positioning yourself in your portfolio? Are you positioning that the domestic economy continues to remain a bit subdued, or are you penciling in a pickup in the second half of the trading session? Because you have been bullish on some sectors like travel, tourism, hotels, etc. What's the expectation on the domestic front for the next 6 months?
Yeah, good afternoon, Rima. So I think while I was just mentioning that some of the recent data points have been a little subdued, one definitely hopes that the festive season is good and the growth really comes back. I think for the year as a whole, RBI continue to expect a 7% kind of a real GDP growth. I think if you look at the budget estimates, we are looking at 10 to 11% nominal GDP growth. So broadly, we are there in line. Of course, if the incoming data points suggest otherwise, we may need to revise it differently. So our sense is broadly we are at that 10 to 12% kind of a nominal GDP growth, and earnings growth as far as Nifty companies are concerned will broadly be around the same lines. Last year, of course, we had the big benefit of commodity prices coming down, and therefore margins expanded. So while sales growth were in single digit, the EBITDA and PAT numbers are much higher. I think this year we may not have that kind of benefit on the commodity side, and therefore the top line and the bottom line growth may be in line. So that is the point I know that I was trying to to talk about. I think broadly, as far as India's domestic growth story is concerned, we remain pretty much on track. Both the investment side and the consumption side largely doing okay. There might be 1 or 2 quarters of seasonality-driven slowdowns and all, and one hopes it kind of picks up along the way.
Okay, Varun, hi, good to have you on. So the commodity side of the market is getting more and more interesting, right? There's a huge focus on metals, courtesy what's going on in China. Then there is a lot of volatility on the oil and gas side. What has your approach been, and are you willing to look at some changes if you believe that the China rally is durable and therefore perhaps the metals move has more steam?
Yeah, I think almost half of the commodity demand for the world, take all industrial metals, take steel, comes from China, and China remains a very big driver of commodity prices. One needs to watch out whether the current stimulus measures announced and discussed and debated actually come through and they help in stabilizing the economy. I think the jury is still out. We'll have to wait and watch. While the market's definitely excited, one needs to really wait and watch out to see if the Chinese growth can really stabilize. And because if Chinese growth comes back, the metal prices can definitely see an uptrend. But I would still want to see more concrete evidence of that stimulus having an impact on the ground. At this point of time, we're more like an equal weight stance on the metal space as far as I'm concerned.
All right. Hi, Varun. Good afternoon. Good to hear your thoughts. What about the IT space? In the next week or so, we'll be getting those numbers that start trickling in. And, most on the street believe that maybe the worst is in the price. From the second half of the year, you could see some increase in spend. And that's what will give a bit of a runaway for growth for FY26 onwards. How do you see things panning out and your approach to the sector?
Yeah, definitely positive on the IT space. I think clearly there are signs of turnaround as far as the US BFSI demand is concerned. I think the mortgage space, wealth management space, all are seeing green shoots. I think the interest rate cut which has happened in US is also very welcome. Over the next 6 to 12 months, we expect the North American banking, which contributes almost 1/3 of the top line of the Indian IT sector, to see better prospects. A lot of deals which were kind of under discussion, there were pressure on pricing. I think some of those concerns can get addressed. So incrementally, we would be positive on the IT space. I think one really has to pick and choose those names which have a significant exposure to the BFSI as a vertical, because that will be the first one to recover from the slowdown that we've been seeing in the last 1.5 years.
Any changes, Varun, to your portfolio, the way you've aligned it in the last 2 or 3 months, given the different winds that are blowing geopolitically on the domestic front? How is your portfolio positioned now, and how has it changed?
So broadly, we remain overweight on pharma, IT, private sector banks. I think these spaces continue to do quite well. We believe residential real estate, we are still in the midst of a big uptrend, and we are only in the mid-cycle. So we remain positive on developers as well as the building material companies. I think power capex continues to be a very, very strong theme, both conventional and renewable. And we continue to see major investment being undertaken by both public and private sector. So continue to be constructive on that side. So these are some of the themes I know that one would prefer. The portfolio is largely stable with some minor changes.
Okay. Varun, just a quick, just to sort of tie in the earnings bit, overall, right, across your analysts that you've spoken with, Q1 was, a lot of companies said, well, there was that heat wave and there was elections, etc., which marred numbers. But Q2 also, across sectors, generally, sense is that it's going to be not such a great quarter. Is that the view you're getting across the board?
Yeah, our sense is the second half is really, post the festive demand comes in, and we see recovery in domestic consumption, and some of the export-related demand also comes back. So I would expect the first half of this year to be a little weak, and the second half is really when we expect the earnings growth, also driven by some of the government capex, which has been a little slow to start to come back.
Okay, all right, got that. Varun, on the capex side, because even before we got into this volatility and this whole global fall, in any case, the market was undergoing a bit of a texture change, right? There was some profit taking in capex plays and PSUs, and we saw that money start rotating back into areas like banks, financials. So have you been tweaking portfolios accordingly as well? And what is your own stance on financials, especially capital market plays? Look at all the policy moves that have finally happened, and stocks are reacting in a very interesting way.
Yeah. So I think if you look at the capital market story, I think there was a very interesting study done by one of the brokers there that from 85 to 2004, if you look at the US, that is the time when inflation got tamed in US and post the Volcker really coming in, and then a very consistent set of low inflation, decent economic growth. For 20 years, the financialization of the US savings really played out, and the sector really multiplied 20x from where it started. I think for India, we have seen almost a 6x. We have come in the last 10 years, and I think we have a long way to go. So continue to be very constructive on the financial savings as a theme, as long as we have an inflation targeting framework, as long as RBI remains determined to keep inflation within that 4% plus minus 2% kind of a range. I think we would have a fairly long period of financialization of savings, where more and more money can come into financial instruments, on equity, on debt, on various other instruments. And therefore, that is a theme that, like in US, played out for almost 2 decades before peaking out sometime in 2003, 2004. I think we are still midway and we have a long way to go.
Right. Varun, Mirae has a China fund as well, right? It's a FOF?
So we do, but Prashant, I would not be able to talk on that. I'll be happy to connect you to the right person for that.
Okay. All right. No, fair enough. I was just checking whether that is seeing any.
No, we do have.
Yeah,
yes.
Absolutely. We'll leave it there, Varun. Thank you very much for your time. Appreciate it. And good speaking with you, as always, here on CNBC. We'll take a break. We're back.
For more news and updates, all you need to do is follow CNBC TV 18 on all of our digital platforms.